This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. With Rishi Jaluria. This is the interview of the day on this, folks. We're going to talk to an adult right now of the melding of all this. How do you get to NVIDIA, which Mr. Jaluria does not cover, over to the software world of Microsoft that we think we know? Rishi Jaluria out of Berkeley and Ross School, Michigan, at RBC Capital Markets, ex-JMP, which is a boutique firm of incredible ability. Rishi, honored you're with us this morning. Okay, they're going to walk in, 2 guys, 5 guys, and 500 engineers, and they're going to make 2 chips or whatever to compete with NVIDIA. Let's start with the why. Why does Microsoft, ginormous Microsoft, have to compete with NVIDIA?
Yeah, and thank you so much for having me in the warm introduction. I think there's 2 reasons. Number one is the unit economics. We can all look at NVIDIA's gross margins and obviously the amazing rally the stock has had and the revenue growth. And Microsoft knows that there's a lot of ability to save money and bring down costs. But I think the more important factor of why they want to bring in their own chips is because there is a major GPU shortage out there. And you are in a situation where it is hard to meet demand. And because of all of this, costs are prohibitively expensive for generative AI. And that can actually be a limiting factor. That's a piece I've talked to when I've had my conversations with companies, is a lot of companies want to go down the route of adopting generative AI in a big way, but the costs are what stop them. By my estimates, a generative AI workload costs about 5 times more than a traditional cloud workload. How do you bring those costs down? It starts with the hardware, and you want to bring that cost curve down to make it more useful. And ultimately, you get generative AI to become a much more prevalent technology.
On a percentage basis, how NVIDIA-ish is Microsoft? Is it a 2-3% bolt-on to Nadella's ginormous company? Or can it be, out 3-5 years, a germane part of Microsoft? Compare the potential size of what Altman can do to the total of Microsoft.
Yeah, from a broader AI perspective, this is going to be more like the cloud. That's the big thing about AI, is it is that seismic technological change, similar to what we saw with the cloud. Look at what happened to Microsoft when they were an on-premise company. Look at where they are as a cloud company, not just their stock price. Look at their revenue growth, look at their profitability, and look at their relevance in the technology world. And I think AI can be a similar accelerator. And the great thing about having Sam and Greg and whoever else joins, if this is how it proceeds, and obviously this is changing by the hour, that Microsoft not only is continued to be a leader in AI, they're actually in control of their own destiny. That was, I think, one of the few knocks that people had against Microsoft, is they didn't control their destiny. They were up to OpenAI. Now this happens kind of all internally. So this can be a major accelerator for Microsoft, and I think this can be a much bigger company as a result.
Rishi, I'm still stuck on this idea that it costs about 5 times, based on how expensive some of the hardware is for generative AI, to get certain workloads done as it does the traditional means of just hiring people. Does it basically mean that NVIDIA's success so far is the reason why the Microsofts of the world, the software-focused areas, have not been able to monetize AI in as material a way?
I don't think it's because of the GPU shortage. I think that is one factor. And then, by the way, I would maybe push back. I think Microsoft is monetizing AI in a big way. By my estimates, AI is already a $500 million ARR business for Microsoft after, 2 or 3 quarters, which is kind of an amazing, unheard of trajectory. For the rest of software, however, I think there are a couple reasons. Microsoft, remember, has a huge head start when it comes to generative AI. They invested in OpenAI back in 2019. A lot of other companies are playing catch up. I think a lot of enterprises are also maybe have concerns around data privacy, residency, and they just, security. And that's also a limiting factor. And I think maybe lastly is a lot of companies are figuring this out. Remember, generative AI is a little bit of a blank canvas, and you have to figure out the right way to use it. Think about the way you and I use ChatGPT today versus what, a year ago when it first got launched. Part of it is obviously it's gotten more powerful, but part of it is we've had to figure out what's the right prompts to ask it, what's the right way to tweak it. And, with APIs, it's maybe 10 times more complex and difficult. I think the monetization is going to come. I just think for software, it's probably a 2025 event when it starts to be material for, the HubSpots and the MongoDBs of the world. But for Microsoft, I would say it is already material and rapidly going so.
When you keep talking about GPU, it's a graphics processing unit, one of the key components for some of these chips that are required for generative AI. Do you think that Microsoft can materially get into the chip creation, the physical world, the hardware game as it ramps up to the software monetary prowess?
I think they can. Now, I would say they're not going to be directly selling GPUs to customers in a big way. I think it's more of you can rent out GPU capacity via Azure, and this becomes a boost for the Azure business. This becomes the preferred cloud vendor to run generative AI workloads, not only because they have, the best AI technology out there, including all these Azure OpenAI services that they're already monetizing, but now they're going to have more and more capacity and again, at a competitive rate versus how things have been. So I think this is more of a unit economics for Microsoft and a boost to Azure.
Rishi, it's a slow day here. We got to make some news. Everybody's piling on Microsoft now. It's one big love fest. We're on our way to $3 trillion. I think it's 404. You're at a 390. The well-dressed Dan Ives and the rest of them are up there. Are you going to be adjusting a higher here when you see this unfold? Can we get you out over 420 on Microsoft right now?
Obviously I can't comment on any price target changes that are may or may not bring. I would point you in our note, we do talk about, a bull case, which would be beyond that. And, you can kind of draw your own conclusions.
Oh, come on. Nobody's listening. We're among friends. What's your bull case? Give me a number here. Can you out-Ives Dan Ives?
Look, my bull case, in the note would be above $400 a share. I think the thing we have to say is right now I'm not modeling huge generative AI revenues in my model. If we start to think about Office 365 Copilot, for example, that's all kind of gravy on top of this. And I haven't even really brought in, calendar year 25, calendar year 26 numbers. So again, I would say you can draw a lot of conclusions based on those sort of things to get you significantly above where the stock is today. But published price target, $390.
Rishi, thank you. Compliance is still in bed. Don't worry about it. Rishi Jaluria of RBC Capital Markets. They wake up at about 8:30 TK.
Victoria Fernandez with his chief market strategist at Crossmark Global Investment. I have no idea how you reallocate, rebalance, Victoria, for next year. What's the Crossmark strategy?
Yeah, well, Tom, as you know, throughout the last year, when a lot of people were trying to make the decisions of whether to be in or out of the market, for our clients, we were completely in the market, but we were being very cautious as to where we were putting our money to work. We had a lot of defensive names in our portfolio while still having a little bit of cyclical names in there. And our strategy hasn't changed tremendously. On days when the equity market is up right now, because we don't think that we're in this solid bull market right now, we're trimming some names and we're going in to some of the names that have pulled back. You mentioned energy. That's one area where we've been adding some exposure to names like ConocoPhillips. We actually are adding into healthcare too. Healthcare has been decimated, but you look at the balance sheets of some of these companies and you have a lot of opportunity there. Adding a little bit of fixed income, having a little bit of cash, using some alternatives in your portfolio like covered calls. We think this is the time when you really need to have that diversification and be ready, because we think there's still quite a bit of volatility to go.
Do you get uncorrelated diversification in fixed income right now versus equities?
Not as much as you probably used to, but what you're going to be using your fixed income for right now is for the cash flow for our clients. So you can get a 5% yield on the short-term part of the yield curve. It's an opportunity to have something a little bit better than cash, a little bit better than government agencies. You can lock that in for a short period of time and then add a little bit, Jonathan, on the longer end of the curve where you can have that longer steady cash flow over a longer period of time to help buffer any equity volatility.
When you look forward, there's a real question about whether rate cuts next year are good or bad for risk. How do you think about that at a time when people are expecting the soft landing as the base case?
So I think there is a misconception here that the Fed is going to cut in the first half of next year. If you look, Lisa, over this hiking cycle, we've already had 6 dovish head fakes where the market has gotten ahead of itself, assumed the Fed was going to be more dovish than it was, and they've had to price that back out of the market. I think we're seeing a little bit of that now. I don't expect the Fed to cut rates until the second half of next year. And I think it will be more because we're seeing a deterioration in the economy than it is because of inflation expectations. I mean, look at delinquencies right now. We're back up at pre-COVID levels in regards to autos, in regards to credit cards, especially in that 18 to 29-year-old age group where they've got student loan debts coming as well. And as delinquencies go up at a time with very low unemployment, what does that mean for banks? It means they're going to increase their loan loss reserves. It means loan growth goes down. These are things that are going to stymie the economy. It's going to stymie the consumer. And I think that's where we're going to see rate cuts come in.
So when you take a look at your risk appetite heading into next year, do you think that people are overly optimistic about both rates coming lower and equities continuing to do well, led by the names that have done best this year?
I do think there's a little bit too much optimism right now, and I'd like to be optimistic. I like to say good things are going to happen, but look, we've said for the last year, you've got to be cautious. You look at leading economic indicators down again. Even coincident economic indicators are flat right now. Consumer is weakening. You've been talking about Mr. McMillan's statement about deflation going on and worries about the consumer. We've heard it in the retail earnings that have come out. And I think you're going to see some of the things that have been propping up the equity markets like buybacks start to come back.
But Victoria, you're living in Texas, the Austin boom. And the Austin boom, is a broad sense, is service sector and technology. How do you underweight the Magnificent Seven?
It's a tough decision to make on what you do with this Magnificent Seven. Obviously, the AI tailwind to those names has been tremendous. And we assume NVIDIA is going to report good earnings, and that's going to continue then to lead that narrative and help that Magnificent Seven. You have to have exposure to these names, you do. But I just think you have to be a little bit cautious and putting all your eggs in that basket. If you have, you've done well this year, so I can't deny that. But as we assume that we're going to have a pullback in this economy and the consumer is going to come back and capital expenditures and spending by corporations is going to slow down, I think you have to be a little bit concerned about what those earnings look like going forward. So have your exposure, but like we said, add that diversification in other areas as well.
Victoria, thank you. We've got to leave it there. Happy Thanksgiving. Enjoy the next couple of days.
Happy Thanksgiving, guys.
Thank you. Victoria Fernandez there of Crossmark Global Investments.
Right now on Fixed Income, Michael Collins joins Senior Portfolio Manager, PGIM Fixed Income. Michael, what is the symbolism of the inflation-adjusted 10-year yield coming in? I got a 2.09% print this morning. That's extraordinary. What does that mean for our viewers, our listeners?
Well, as you know, the world's discount rate, the U.S. Real yield is what's driving valuations on everything in the world. And that real yield, Tom, at 2.1 or so, is probably still 100 basis points too high, right? I think it's supposed to be somewhere between 0 and 2. So I think there's still room to go there. I think if you believe the real yield should be above 2 permanently, remember it was at 2.5 just a few weeks ago, you're buying into the notion that we're going to have this continuation of really strong real growth in the U.S. and around the world, and it feels like that's not in the cards.
What is your x-axis to get even halfway there? That's a bold statement by you at the inflation-adjusted yield 2.50 down to 2.10, and it will, I'm going to use this word carefully, Michael, plunge lower. What's your timeline to make that happen?
These things tend to happen more quickly than the markets price in, right? I mean, just a few weeks ago, the markets were pricing in a funds rate that ended at 4.5% and never got lower than that over the next 10 years. And now that number is 4, right? So the markets are pricing in kind of a permanent funds rate at 4. And again, that probably is 100 or maybe 200 basis points too high as well. And we do know when the Fed is done, and the Fed is done, that's why the minutes today don't matter. When they're done, rates rally, right? That's the beginning of the rally in the bond market. As soon as the message is clear that the hiking cycle is over, because the markets always overshoot on the upside and then they overshoot on the downside. So I think we just hit the overshoot at a 5% 10-year, at a 2.5% real yield. And now we're probably on the way down. I mean, rates today maybe look fair value in a good world. But, we've had disinflation, as you've all talked about this morning, and it's been driven almost solely by the supply side, the huge rebound in the supply side, both from the labor market and the productivity boost. And I worry that 2024 is going to be a demand side story. And that's the bad disinflation, right, that we're worried about. And if that plays out, if inflation ends up having 1 handles instead of 3 handles, which is very possible, and we're kind of moving in that direction pretty quickly now, who knows? Rates could be offsized by quite a bit.
That's the worry of equity investors as well, Mike. Let's talk about bigger picture. And I'll do this for you because you're far too modest. About 10 years ago, you and a team, I'm thinking Robert Tipp, Greg Peters, were really known for this call of low interest rates, low inflation, range-bound yields, low and range-bound. I remember the phrase. It was the low ranger. Now, Mike, that was 10 years ago. You guys won awards for all of that. We celebrated them on this program. A decade later, post-pandemic, can you talk to us about this regime and how different you think it will be?
I mean, certainly you're in a world right now, Jonathan, where you're seeing a kind of generational high in capital investment in this country in technology-related things. You've been talking about AI all morning, right? And it's happening, and it's real, and it's increased our productivity in this country significantly over the last year. And there's a chance that is sustainable, that this AI and the robotics and all of the technology investment does lead to more sustainably and higher real GDP in this country, let's say in the 2s as opposed to in the 1s. And that's a big difference. And there's also a chance that inflation, doesn't fall back to 1.5, that it gets stuck at 2.5 or 3. And I think geopolitics and climate-related risks and energy transition and shortages of labor around the world are all factors that could lead to stickier inflation. So yeah, there's this big high probability scenario out there that, that heck, maybe, like I said, rates are fair value here, that the funds rate bounces between 3 and 5 for the next 10 years, and the 10-year bounces between 3.5 and 5.5, and maybe you're in the middle of that range now. So that's a scenario that we're really contemplating very seriously as a pretty high probability. But of course, you do have to be humble in this business, and that downside risk is always out there lurking and looming. So it's something we're certainly looking at. Have
you gotten more conviction over the past 4 weeks, Michael, as the market seems to be accepting the idea of possibly more aggressive rate cuts next year?
More conviction on rates. Maybe a little bit more. I think the inflation side is really what's given us more encouragement. The disinflation story seems to be kind of embedded now, and we're not as worried about a permanently higher, inflationary environment, right? So that's really a big delta that we're seeing recently, with goods prices in deflation right now, right? And services inflation is finally coming down. So, and the labor market is seeing some cracks, right? Which leads to lower wages. So all those things give us encouragement on inflation, which give us encouragement that, hey, maybe we've seen the high end rates, and who knows, maybe the next move is 50 basis points lower instead of 50 basis points higher. On the credit side, though, the markets have run with this low inflation, soft landing world, and and the equity market too, right? So risk assets have rallied hard just in the last few weeks. And I think you're supposed to be really careful there and fade those rallies.
Feels like a much tougher call on the credit side. Mike, thank you, sir. It's good to catch up with you. Mike Collins there of PGIM Fixed Income.
Sometimes you get lucky, and we do that always with Robert Hormats. He is of Tufts, and he's of generations of presidents. This could easily be a 3-hour conversation. Ambassador Hormats with the Yale School of Management. So many narratives. Bob, you and I could go for 3 hours right now. We got about 7 minutes. There's James Earl Carter with Sadat from another time and place. We have a nostalgia for that moment that you lived and the success with Brzezinski and the rest that you lived. What imagery are we going to see when we extricate ourselves from this war in Gaza?
Well, I think at that point there were two interlocutors that Carter was trying to pull together and was able to do that. Now you have a much different environment. You have Hamas, you have the Israelis. The Israelis are divided. Hamas is a very inchoate kind of operation. You know, it's not quite clear how much power the center of Hamas has. It's a very dispersed organization. And we really, with hostages, as you've correctly pointed out, you really don't know until it's actually done. Remember the movie The Bridge of Spies? They didn't actually know that the transfer was going to take place until it did. They arrived. Right. And I think these things are very sensitive. But what's very important about this is that the United States and Qatar have played this intermediary role, which I think is constructive, and that it gets the United States back into the game in a positive way.
Robert Gates, my essay of November in Foreign Affairs magazine, it's a primal wake-up call on American diplomacy is being efficacious. You have said this for decades, Bob Hormats, that we can't let down our diplomacy. What does our next diplomacy look like after what we've lived the last 8 or even 12 years?
Well, that's the interesting point, that is, during the Cold War, diplomacy was Washington, Moscow, essentially. And now you've got lots of power centers. Obviously, this summit with the Chinese was, I thought, a very constructive summit. And actually, I'm going to China in a week to talk about what kind of progress can be made to support what was done in the California summit, but opening up new opportunities, I think, for business and for diplomacy. But talking to a number of people about how we move the very constructive process that was begun there along. But you also have a variety of new power centers that you have to have very proactive diplomacy. India is playing a greater role, particularly in the global south. Iran's a power in the region. Saudi Arabia is playing a much greater role. So you have to have a much more agile and a much more diffused diplomacy. There are lots of power centers of different levels of power, but a lot more influential countries than there were in the past.
Which is the reason why there was a lot of focus on China's meeting recently with Arab leaders and wondering how exactly they were navigating something that they really haven't taken a particular stance on. What did you glean from that?
Well, that's a very good example of this. The Chinese really, for years, played virtually no role in the Middle East. They have a base in Djibouti, but that's sort of north and out of the framework. It's really on the tip of Africa. But they were not engaged in the Middle East. Then, sort of a surprise, we find that they brokered a deal between Saudi Arabia and Iran. So it's clear that they have a new, positive, proactive, and I would say in that case, quite constructive diplomatic approach. They have very sophisticated diplomats. We shouldn't underestimate the quality of the Chinese diplomatic corps. They're very good. So they're playing a greater role. And the fact that we're now re-engaging or engaging in this diplomacy to help deal with the hostages with Qatar sort of shows that we're now coming back into the game and playing a constructive role. But we're going to have to do this in a whole lot of countries because there's a lot of power centers, and we're going to have to play a role if we want to play a global role in a variety of regions. The
more I read, the less I feel like I know about what's going on in the Middle East right now, in terms of where the power centers are, who's brokering what, how, whether Saudi Arabia is getting more sort of aggressive with Israel or not. Do you have a sense of just whether there still is this animosity between Iran and Saudi Arabia, of whether there is this move from Qatar and Egypt and others to move away from Israel? Do you have any sense of exactly how this tide is shifting?
It's very hard to read the tea leaves. I would say that Iran and Saudi Arabia probably still have a lot of questions about each other and a lot of suspicion, but at least they're engaging in conversation in a way that they weren't before. And I would say it's probably true as well. I do think that the Sunni Arab countries in the region did want to have, and still do want to have, a close relationship with Israel. This, and one of the reasons I think Hamas did this horrible thing, is that it didn't like that was going on, and thought this would interrupt that process. So I still think the underlying goal is to have a greater degree of normalcy between Israel and the Sunni Arabs.
You just celebrated your 80th birthday, and I think I can say between you and Michael Bloomberg, you are as well preserved as anybody I know. What's the damn secret to looking this good at 80?
Getting up early and coming on this show.
Okay, that's the right answer.
That's right.
I want you to talk right now about this crazy American gerontocracy that we're living right now. The president's 81, the other guy's 78. How did we get, half of Congress is 92. How did we get here, Bob Hormats?
Well, you've asked a question with really two powerful ingredients. One is we certainly need to begin to tap the younger political leaders, and there are plenty of very good people who are in the process of moving up in the political process, but the older leaders have sort of taken the oxygen away from them. They don't get to participate in a lot of the proactive debates that are going on, because you've got two leaders who are older who take a lot of that oxygen, the political oxygen, and money away. But the second point that's even bigger is we have to start thinking a lot more of the implications of what we do today for the next generation and the next generation and the next generation. That particularly has to do with the budget, because we're leaving our children and grandchildren with.
Well, this is your book from a couple of years ago. Right. When's the second edition out?
And
you got to redo it.
I just did an article for Fortune magazine, explaining why this was a problem and what it was going to mean for Social Security, what it's going to mean for the budget, for contingent liabilities, and the numbers are up and up and up. Who's going to pay the interest? Our children and grandchildren. We're leaving them with a burden. That's one. Climate's another.
Breaking news is getting in the way. Bob Hormats, I got to cut you off. Thank you so much for joining us. Anne-Marie, to you, 20 seconds. Any breaking news here into the 9 o'clock hour?
Just that we remain very close to getting this hostage deal done. We also did hear from the Israeli Prime Minister, though, Benjamin Netanyahu, and the Israelis are tweeting that they will have a war cabinet meeting this evening.
Stay for this, and Anne-Marie Horton, Balance of Power. Look for that this evening. We say thank you to Robert Hormats of the Yale School of Management. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.